Okay, so we'll continue from where we have left. So yesterday we started with the new chapter on auditing of a group audit, CFS audit. Okay, let us have a quick recap of what we have learned. So chapter 13 had four concepts. The first concept is about the basics of consolidation. So when we talk about the basics, one question comes, is it mandatory? Yes, it is mandatory. Are there exemptions? Yes, exemption number one you have got for your wholly owned subsidiary. Second exemption, government can give. Third exemption, investment entity as per 110. Fourth exemption, temporary control as per accounting standard. These are all the four exemptions available. Now, what is the responsibility of management? Now, responsibility of the management will be to prepare, to identify the cases of who should be consolidated, reportable segments, related party transactions, completion of the information, adjustments, okay, and gap conversion. Okay, we can say gap conversion. These are all the responsibility of the management. Then we have to talk about the responsibility of auditor. Does auditor has any responsibility? Yes. The responsibility of the auditor is first check whether as per the framework. Second, express true and fair opinion. Third, comply with the standards. Fourth, comply with the government regulatory requirements, like making inquiry of section 143(1), considering section 143(3), CARO. Okay, so these are all the requirement. And fourth responsibility is to look for comply with the responsibility of SA 600. Okay, this is what we can say. So this is all about your first concept, where you talk about the mandatory things, responsibility of the management, responsibility of the auditor. The second concept goes about your audit considerations. So what are the special considerations you need to have? So primarily we have got two considerations. One, acceptance. At the time of acceptance, what are the considerations you can have? One, FRF, Financial Reporting Framework. Is it accounting standard or Ind AS? Second, SA 600. Am I a principal auditor? Are component auditors? What is my knowledge about the components? Then other information. Is there any information which is not there in the SFS, which is part of the CFS? Then materiality. Okay, so when it comes to materiality, why it is required? Because you have to design for a group as a whole to look for consolidation adjustment. Second, you need it for evaluate the material misstatements or reporting by the modifications by the component auditors. Third, you can use to look scoping of the components. Fourth, you need to communicate. Fifth, you need to coordinate and get that confirmation. That's it. So then today we are going to second thing, we are going to say plan and perform. This is very similar to what we have done in SA 800 series. Okay, because this is more like a special audit now, what you have got. So you have to plan and perform. Okay, students. So today we will proceed further. We'll see how to plan and perform the audit. Okay, auditing the consolidation. First, they said that auditor has to make a plan. So auditor should plan his work so that you can conduct the audit in an effective manner. Okay, so we can move further. Now, what are the plans you need to make for? The auditor should make the plans. You can mark it important for the following or important aspects to be considered in the auditor plan. One, very importantly, understanding of the group structure, like what type of controls they have for doing the consolidation. See, you need not go into the business controls. Please understand, you are the consolidation auditor. Your scope is not the business here. Your scope is only consolidation. It is more like a summary financial statement. You remember, no? So you are going to express opinion based on the, like, what is the summary financial statement? Something prepared from the main statement. So similarly, you have got SFS and you have to prepare CFS. So your focus is on the preparation of the CFS and applicable framework, and you're not concerned with the like from where the numbers came, what type of business risk they had. That is the individual standalone auditors have considered it. So that's why when you talk about group-wise controls, okay, so you need not think about the controls of the business controls, but they are all consolidation controls, like identify, like what type of Hyperion system have you used, okay, general and IT controls, manual controls for the consolidation process. Please understand, it is not their business process. So first thing, you need to obtain the understanding of the group structure, because you need to know how many subsidiaries are there. There are two levels of subsidiary? Is there a foreign subsidiary? The very first condition, you need to understand the group structure. Second, you need to understand the group's policies. Why? Because they said that you need to harmonize. Harmonization means all the subsidiaries can follow different policies according to their jurisdiction. That is connected with the standalone statement. But when it comes to consolidation, you need to harmonize it. You have to change it. That's which understand their accounting policies. Next, you decide your nature, timing, extent based on the assessment of the risk. Okay, like how should you do the consolidation? What type of procedures you need to do? See, when we talk about the plan, this is what we discussed. Okay, so here strategy and plan is together. See, these are all part of your strategy. Nature, timing, extent is nothing but the plan, and determine the work of other auditors, other auditors work. Like to what extent other auditors are involved, whatever, you decide that and coordinate the work to be performed. So I hope it's clear, students. This point, very important, please mark it. So the question here will be, because they are not asked any questions, I believe. Questions here will be, what all the plan or auditor need to consider while planning for group audit? Simple. You can write 4 or 5 points. It is done. So you are done with the say 300. You have planned. Then you have to perform now. Now completeness of the inclusion. Now a parent which presents a statement required to consolidate all the components other than those for which exceptions are there. How many exceptions? 4 exceptions are there. So what you should do now? Obtain the list of all the components, review their information, and check whether they have been included. Okay, if we go back to summary financial statement, what is that you should be doing? Obtain that audited financial statement and check whether the summary has been done properly. Grouping has been done properly. Now, how do you know whether the management has given you complete information? There can be a situation where there is a subsidiary, but they are not given information. Something might have been shown, okay, they are holding only 5%. Okay, you may think that is not a subsidiary, but actually they are controlling. So in this organization, NCI is 95% and you are supposed to consolidate as per India's 110. So how do you know when you ask management that the information what they have given is complete or not? Yes, for this, you have to follow following procedures. So this also they can ask you. Completeness of the information. See, this is all part of your planning and performing the assignment. Now, review the working papers for the prior periods for the known components. First of all, how do you know how many components are there? Check your last year audit report. Check your last year working papers. So you must have made some notes there. Okay, these are all the consolidated subsidiaries. At least start from there. Ask questions to the management. Sir, why you are not consolidated this? Have you sold them during this year? Second, you check the parent's procedure for identification. Okay, so this is what you already know. You now check the test of controls. Like ask the controls. Like, sir, how do you identify it? Make inquiries of the management to identify any new components. Okay, first here you are checking the process, internal controls of the management. Here you are making inquiry. Sir, is there anything new added? Or is there anything went out of the consolidation? Review the investments of the parent to determine the shareholding. How? You look into the investment register. You look into the returns which they have given to ROC. Because if they have acquired the controlling interest, then they may have to follow certain procedures. And if it is listed entity, they must have to inform SEBI also. So just check their investments. From their investments in the balance sheet only you will come to know. Okay, then you can start asking questions. Sir, you are holding only 18% here. But are you controlling it? Because that you may not be aware. Because you just cannot go with the 18% as per India's. You have to go with the concept of a control. Now, review the joint venture arrangements and the joint ventures and joint arrangements. Okay, India's 111 talks about it. Okay, so whether it's a joint arrangement or a joint venture. In case of joint arrangement, you need to have a that consolidation like individual consolidations. Joint venture will have equity method. Review other arrangements entered that have not been included in the consolidated financials, like for example, special purpose vehicles. These are all the, or they may be a partner in the one partnership firm, and they may not have consolidated. So we can call it as an other arrangements, which is not there. Review the statutory records, like registers, as per section 186, 190, like intercompany investments. Like if you have intercorporate investments you have done, because they must have done with the objective of acquiring the control, and identify the changes in the shareholding that might have taken place during the year. So these are all the information, because see, first step is what you have planned. So you have started to do. So probably first you ask the list of the components from the management. So tell me, because I have to start consolidation now. Now one question comes, what is the guarantee for you that this list is complete? They might have left something. They might have included something which not supposed to be included. For which you are supposed to perform these procedures of completeness. Yes, you can ask me any of the doubts if you have. Okay, and then otherwise we will proceed, and you need to document the procedures performed for assessing the completeness. Whichever you are going to do, you need to make a document. Let us see, test your understanding question number 1. Okay, I think yesterday we have seen this responsibility of the management. Okay, so all these questions we have seen, I believe, we getting 51%. Yeah, I think from question number 10 is what we are supposed to see. Okay, but we had left one question on test your understanding 1. Where is this test your understanding 1? One minute, friends. Yes, this one. Yeah, 10th question we had left. Yeah, we had covered this also. Now, Mukund is a second year of his term as a chartered auditor of Style Mark Limited. The second year means, that means first year already you must have done the documentation. Holding company, it's a subsidiary and joint venture. See, this word only should tell you that this is from chapter 13. While planning the audit, he wants to be sure all the components have been included. So these components are included. This itself is another keyword for you in the consolidated statements. Yes, list some of the procedure for checking the completeness. So you are very clear that this is what they are talking from the audit consideration point of view. Concept number 2, performing of the audit, where you have planned and you are going to verify. So obtain the list, check the completeness, and perform these procedures and do the documentation. That's why straightforward question has been given. Next, understanding of the nature of the control. Now there would be various means. See, now here what you did, you have to plan to understand the group structure and the control. This is what you are planning. Here you are actually trying to understand. There would be various means by which control, joint control, and significant influence can be obtained. Like how nature of the control means how you are controlling the subsidiary, how you are controlling the joint venture or associate. There can be a situation where some you are holding 25%, but you do not participate in the decision making. So it may not be your associate. So how to know whether you are what is the nature of the control you need to have? The entities exercising. Yes, for this now you need to understand the board's minutes, shareholders agreement, agreements with the entities which provide the any technology or the know-how, because sometimes for this again we have to go to India 110, because India's 110 tells that you might have controlled one organization by providing technology or know-how. In that case, your equity interest is 0, NCI is 100%, but still you have to consolidate their assets because you are controlling that organization, and you have got a variable element, and you have got an ability to get that variable portion from the business, and enforcement of statute as the case may be. So you need to verify the board meeting, shareholder agreements with the technology providing partners, and your law. Enforcement of statute means the legal rules, law and regulations you need to understand. Okay, let's see, test your understanding knowledge 6 question. A Limited holds the ownership of 10% of the voting power, but still it controls the composition of the board of directors. Are you supposed to consolidate? Yes. While planning, what factors would be considered that consolidation prepared as per Ind AS? What factors would be considered by you as the statutory auditor of A for the audit of his CFS prepared under Ind AS? Okay, 10% of the voting power, but having control over the composition. So you hold only 10%, but you need to plan for certain things like how you are going to control. Like the auditor should verify A Limited's management assessment, how A can control the composition of the board just by having 10%. And what is the means of, how do you come to know? How you can verify it? You can check the minutes of the board, agreement with B Limited. Further, auditor should verify the adjustments required by 110, permanent adjustment and current period adjustment. Review the information of the related parties as per SA 550. And in forming of the opinion, you need to follow that, that you need to check whether the schedule 3 has been followed. Yes, you can mark this question as an important question, students, because see, there is no straightforward answer in the study material. They have taken it from different aspects. And you will not come to know also what they have not told you any keywords that they are talking about the understanding of the nature of control or something like that. Okay, so how do you audit the consolidation? Because despite someone is 10%, now that's why major marks we can assume will go for this verification of your control and then checking of the other elements of the CFS. I hope it's fine. Now, examine the exemptions, because when the lists management would have given, you have seen completeness. Okay. Now, at the same time, if someone has been left out, you need to verify the exemptions. The third thing I can say. So, the first procedure for you is to plan the audit. Second procedure for you is to check the completeness. Third procedure for you to understand the nature of the control. Fourth procedure is to examine certain exemptions. Now, the auditor may also review the minutes of the meeting. Subsequent to the year end, is there any liquidation of the investments, or if the control needs to be temporary, if you are doing as per accounting standard. Where any component is excluded, look for the reason. For example, company's accounting standard rules, there can be two reasons for exemptions. Okay, that means this is not only coming from accounting standard, but company's accounting standard rules also talks about it. But in Ind AS, no, this exemption do not apply. Now, now one question comes, sir, what about the Companies Act says this exemption is available, Ind AS says exemption is not available. Then should we consolidate or should we not consolidate? See, this problem is not going to come for accounting standard, because accounting standards and Companies Act says same. But when Companies Act says something and Ind AS says something, Ind AS says there is no exemption. So this is called case of a conflict, and MCA's notification says your Ind AS prevails. That means this exemption is not become applicable for Ind AS compliant entities. Are you clear, students? So the relationship of the parent and subsidiary is temporary. Other long-term severe relationship, long-term restrictions to exist. Similarly, under Companies Act, intermittent subsidiary is not required to prepare if it meets the three conditions: wholly owned subsidiary and NCI do not object, securities are not listed, and ultimate intermediate parent company prepares the CFS. So primarily they are talking about the two exemptions here available under the Companies Act. You have to check if someone has been excluded. You have to see why, which exemption is applicable. Ind AS 110 also prescribes certain criteria. Auditor should satisfy the exclusions are made by the management falls within these categories. Like entity which is excluded from the consolidation on the ground that relationship is temporary, verify that the intention of the parent to dispose of the subsidiary or associate or jointly controlled entity existed at the time of acquisition only. That means later, in order to avoid consolidation, don't tell that we have acquired on temporary basis. So the management should prove that their intention was only temporary and they just want to get rid of it. That is what they can do. No, simply to avoid consolidation, they may say no, we don't want to do it. So again, when you are verifying exemption, you can note this point. You can note this example. Okay, so you can tell What is the examine the exemptions? If anybody has been left out, point number 1, look why. You can tell like that. Examine the exemptions. This is the 4th procedure you need to perform. The first question you need to check why it is excluded. The reason. Is it because of this? Is it because of this? Is it because of this? That means there are 4 reasons. Second, if you are talking that it is left because of it is temporary, see, this particular thing depends upon the intention of the management and you don't have any evidence. That's why always look for the intention at the time of acquisition, not the time when it comes for consolidation. Now, verify the reasons for exclusions that are given in the CFS. Reasons other than those allowed by the applicable reporting framework, consider the effect on the report. That means if the management is giving something different reason only, which is not permitted in any of the 4 categories of exemption, then you have to modify your report. So I hope students you are clear. So the procedure number 1 is to plan. Procedure number 2 is to understand the control. Procedure number 3 is to examine the exemptions. And procedure number 4, you have to examine changes in the status of components. So auditor should also examine, is there any changes in the status of the component, like subsidiary has become joint venture has become subsidiary, because there can be possibilities of step acquisitions. Now, if yes, what to do then? Then check whatever your Ind AS 110 is going to tell about it and whether that has been appropriately accounted. Very simple. As per the reporting framework. Now, your step acquisitions or step disposals will tell you certain things. Okay, so it says that your equity changes should not be recognized if you are, unless you have lost the control. Okay, so OCI has to be transferred back to the P&L. So many procedures it will say. So that's what you need to check. And check for the consolidation methods. Okay, how many methods are there? Primarily we have got 2 methods. One is called a full consolidation, another is the equity method. Okay, in a full consolidation you do 100% consolidation and take the NCI share separately. In equity method, you are then like an NCI. See, previously in accounting standard, we have got one more thing called a proportionate consolidation method. But in Ind AS, we have got only full consolidation or equity method, because for joint venture and associate, equity method becomes applicable. But if you are following accounting standard, for joint ventures proportionate, that means if you are holding 50%, 50% of the assets you consolidate. Just like your 100% consolidation. You take only 50%. But today in India, for these 2, we have got equity method. So you need to check what method they have followed now. So in preparing the CFS, as per the accounting standard rules, the parent and subsidiaries are combined on line by line basis. This is called a 100% consolidation. Adding all the items together like assets, like liabilities, income, etc. Certain calculations are done to determine the goodwill. This is the one-time adjustment. You have to do elimination of intra-group transactions and check whether this is done as per AS 21. This is method number 1 if accounting standard is followed. In the same accounting standard, if you are doing investment in the associates, this is in the subsidiaries, then you should be using equity method as per AS 23, where you take your share of equity, your share of profits, less your dividend, and then your share of fair value adjustments. If it happens to be a joint venture, then you need to follow the proportionate consolidation method as per AS 27. And this is what I also studied. Over time, for finals, we had AS. Now, many of the procedures, application of the equity method and the proportionate method are very similar to the consolidation procedure set out in AS 21. Okay. This is for whom? This is for the one who follow accounting standards. Now, what consolidation methods you have got for someone who follow Ind AS? Yes, for Ind AS, if you are doing audit of, if you are consolidating subsidiary, you should do line by line consolidation, like assets, like incomes, like expenses, like revenue items. That means you have to club it. Then one time goodwill or capital reserve calculation has to happen as per Ind AS 103, and you need to compute the NCI or minority interest also. If you are doing business control under common, business combination under common control, pooling of interest method should happen, no fair valuation. Reserves identity should be maintained. Otherwise, If it is a purchase method, reserve identity has to be left out. It's so easy. Huh? If this question comes, you can straight away score 5 out of 5. Bring your India's knowledge. Then eliminate all the intra-group transactions. Okay, done. What if you are doing investment in the associates or the joint venture? See, for both investment in associates and joint venture, you need to follow equity method. That means there is no concept of proportionate consolidation method. Interest in assets and revenues, expenses in a joint operation are accounted as part of the separate financial statements as per Ind AS 111. The Ind AS 111 tells you two things. What is Ind AS 111? Joint arrangements. Joint arrangement will take two forms: joint operation, joint venture. See, what is the difference? Primarily difference here, there is no separate identity for it. It's just an operation. Here you have created separate identity in the form of a company or something. So for a joint venture, you have to follow equity method of accounting. But for a joint operation, you need to take your share of assets, your share of liability, your share of expenses. That means there is no concept of reserve and all. Okay, so it is 111 is going to govern about it. You can talk about it. That joint operation should have accounted as part of the separate financial statements. And whatever in the CFS comes from the separate financial statement of the parent only. So in this separate financial statement, your joint operations are included. So automatically it will flow into the CFS. And what if you have done business combination in stages? Yes, you may have to remeasure the previously held equity in the acquiry at its acquisition date fair value and recognize resulting gain or loss on the P&L. No goodwill. Goodwill comes only once you acquire in the initial stage. Okay, if you are acquired in the stages, you may have to just remeasure your previous values. Okay, and appropriate as per Ind AS 103. Okay, see, in the examination, this question has already come. Okay, so it's a question number 17. We are in question 14. Okay, 17 you may have to shift it, students. By mistake, I had given it here. Now, R Limited is a listed company engaged in the manufacture of round bars. Company is having investment in the subsidiary joint venture. Okay, when you look at this only, chapter 13 strikes to you. Now, you see, they have given this question in test your knowledge level. Okay, but this question has already come. See, this was updated in May 25 study material. In the original study material, this question was not there in May 24. This question came in May 24 and the question got repeated in test your knowledge. So, remove this test your knowledge, remove this priority. Okay. Now, business entities under common control, interest in assets, liabilities, revenues in a joint operation. Now, R Limited and all its components are required to present their accounts as per Ind AS. So, they gave clarity. While preparing CFS, R Limited consolidated its components on line by line basis. Now, is it correct? No, wrong. Because line by line basis is applicable only for this. For other joint venture and associate, you have to follow equity method. Business control under common, yes, line by line is okay for this also. But you need to have a pooling of interest method. That means reserves also you have to take. For subsidiaries, you should not take reserves. Interest in assets liability of a joint operation, you need to consolidate at a SFS level. And from SFS, it should come. So, seeks your advice, accounting treatment. So, you can write the consolidated. So, you can write the story, what we have seen there. So, in the given situation, they have made a mistake. They have got subsidiaries, so and so, so and so. In view of above, R is supposed to consolidate component line by line items, which is correct for the subsidiaries. However, it is not correct for other components, and other components need to follow the other way. Okay, so in the study material, what they have given, no, they said, okay, maybe because of that reason, I might have marked it as a priority one. They didn't tell you the answer. They said refer para number 5. And they in the given and the conclusion part was given in the study material. Probably that's the reason I must have marked it. Yes, you can remove this because they have already asked this question in the exam. I hope it's clear, students, by now. Yes. The auditor should verify the adjustments warranted by the relevant accounting. So this is also part of your method because they only told you need to remove the intra-group adjustments. Okay. fair value adjustments you need to do. So all these things you have to verify and check whether they are made and have been made wherever required and have been properly approved by the management. Pay close attention to the off-balance sheet entities. What is this? Special purpose vehicles. So something is not sitting in the balance sheet or consolidation. We pay a special purpose, like special consideration. And further, de facto control should also be considered. So what is the de facto control? Investor with less than the majority voting power, say for example 10%, and practically able to direct the relevant activity unilaterally by controlling the composition of the board of directors. Why? Because 90% is held by the general public and nobody is attending your annual general body meeting. Even though they attend, they don't have a unanimity, they don't have any contract among themselves. So who appoints the board of directors? This person holding 10%. So such de facto controls has to be given special consideration. You need to check it. Yes, so this is all about your the concept number. See, I think we can add the special considerations also. I think we can reduce it. So we can create a structure. I think I can bring it as a planning only rather than as a separate concept. So I can say group audit can have three concepts. One, basics of consolidation. Okay, includes responsibility and other things. Then we can group it under something like this: audit consideration or auditing of group, auditing, and then reporting. In auditing, acceptance, client acceptance, considerations. Okay, so sorry, planning and performing. Plan and perform. So plan and perform has got plan. We can say you have to plan it. Then you have to say completeness. Then look for exemptions. Then consolidation method. That's it. And then special consideration for adjustments. Now, how many types of adjustments? Permanent adjustment, temporary adjustment. Yeah, I hope this structure should be very easy for you to remember. Okay, so you can create a mind map like this. So basics has got three elements. Is it mandatory? Responsibility of parent, responsibility of the auditor. So acceptance, certain considerations you need to make, like materiality, etc. Now plan. Okay, and then report. Okay, somewhere when you look at this particular chart every day, see this particular thing comes to your mind. Chapter 13, concept 1 to 3, sub-concept 1 to 3 are like this. Chalo. Now I think, yeah, we should be, I'll change it going forward. The special considerations also I'll put part of your work only. So when you talk about consolidation method, you are trying to learn about consolidation method. Point number 6 is you have to give certain special considerations for two things. One, permanent adjustment, temporary adjustment, current period adjustment. Now, what is the permanent adjustment? Permanent consolidation adjustment. Again, it is also very easy for you. It is only on the first occasion of the change in the shareholding is what you are going to do. Like Ind AS 103 is going to talk about it. Now, what you do in Ind AS 103? Simple. The ultimate purpose of 103 is to prepare that first consolidated balance sheet where you determine the goodwill. Second, you determine the NCI. And this will remain forever now until it is your controls will remain. And this is subsequently subject to impairment. And this will subject to changes in the NCI because of the additional profits what they make, the subsidiary makes. Check the calculations are done appropriately. Now, what are the additional consideration? Now, okay, what is that you should be considering when you talk about permanent adjustments? Very important part is the date of acquisition, because there should be a distribution of pre-acquisition reserves and post-acquisition reserves. So this pre-acquisition and post, because pre-acquisition reserve will go and become part of the goodwill. Post-acquisition reserve is going to become part of your other equity. So what is that decides pre-acquisition and post-acquisition cutoff? That is your date of the investment. So one of the special consideration you need to pay is your permanent adjustment. In that, pay a very special consideration to the date of adjustment because it will decide the pre-acquisition reserves. Examine that the pre-acquisition reserves have been allocated properly between goodwill and NCI. These all calculations you have done in FR. Now, the auditor should verify the changes that might have taken place in this permanent adjustment subsequent to the acquisition. How these changes are going to happen? Only two ways. If you have got a goodwill, it will get impaired. But you need to check how the goodwill was calculated. Full goodwill method or partial goodwill method. Why? Because when the impairment happens, whom it should be allocated? Should I allocate to NCA or should I allocate fully to the parent? That depends upon the goodwill calculation method. So this is one thing you need to consider, impairment of the goodwill, and NCA will subsequently change because of the profits post-acquisition reserves or post-acquisition profit plus the dividend of the NCA. So on 1st April 24, parent acquired 60% of subsidiary, NCA is 40%. On 1st July 25, parent acquired another 20%. Now because of which what happened? Subsequently your NCA step acquisition also can result into reduction in NCA. Now NCA reduced to 20%. So this is your subsequent change. Subsequent acquisition of the shares. I'm sorry students, I was talking about the goodwill and all. No, they are talking about the subsequent acquisition of the shares. So once you have acquired, subsequently you acquire additional shares or you dispose it, then you have to verify the changes have been properly happened in the NCI. Subsequent acquisitions are not going to change your goodwill. Goodwill will get changed only when the impairment is going to happen. Otherwise, you sell the subsidiary. Now, it may so happen that in some cases, in one case, goodwill arise and in another case, capital reserve arise. You remember students in FR, there is one problem. They are given in the form of a table. That means in one case, there is a goodwill. Another B limited, there is a capital reserve. C limited, there is a goodwill. D limited, there is a capital reserve. So what you should be doing, the entity may choose to net off this amount and show the single amount rather than showing capital reserve on the liability side and goodwill on the asset side, where permitted under the law. However, you should show the gross amount of the goodwill and the capital reserve should be disclosed in the notes to account. So this is a special consideration coming to the permanent adjustment. See, they are talking only about the special consideration for the permanent adjustment. And I think it's very easy, students. Okay, so XYZ, we'll see one test your knowledge question. XYZ is the company engaged in the manufacture of tires of four-wheeler. The company has invested 70% during 23-24. That means it acquired control. The company reduced the control from 70 to 55%. So because of this, NCI got changed. Certain adjustments were made to the accounts for the change in the share of equity held in XYZ, whose financials are being consolidated. Such kind of adjustments are known as permanent consolidation. So when the NCI got increased from 30 to 45%, this is part of your permanent adjustments only, not your current year adjustments. Okay, so permanent adjustments primarily includes your goodwill and your NCI. So you have to keep certain considerations in mind, like how it is calculated, how subsequent changes have happened, what changes have happened in the subsequent period. Okay, so like your acquisitions only. Okay, this is what we are going to consider. I hope it's clear, students. So particularly goodwill and NCI. So how it is originated based on date and what subsequent changes have happened due to the acquisition of the shares only, and how you have presented it in the balance sheet. Yes, these are all the 3 points you need to keep in mind when you talk about the permanent adjustment. Now, what is your current period adjustments and what is your special considerations? Now, current period adjustments are made in the accounting period, like your subsequent profits, intercompany eliminations. They told you, see, sale is 100 by parent to B, cost is 6, gross profit they earned. So SFS shows the profit of 40. Similarly, they made a similar sales to another subsidiary C, and they SFS shows the profit of 35. Now, entire 100 was sold at 120 to the third party, and they made a gross profit of 20. And this was not sold. So your sale is how much now at a consolidation level? 120, because 100 sales, 100 purchase gets eliminated. See, cost and sales got eliminated. Okay, so here also sale and cost got eliminated, but you have got an unrealized profit of 35 now on the inventory that will get eliminated. So your cost is going to become 60. So for a group as a whole, what is the profit you made? 60. The breakup. 40 is coming from SFS of A, 20 is coming from here. Now what about this 35? It will get eliminated because of the inventory. It is sitting in the inventory of C, so you are going to eliminate it. So this is your current period adjustment. I hope it's clear, students. You have any doubt? See, your knowledge of accounting helps you to understand very easily. That's why it's a very easy chapter. That's why very few exam questions. When other questions are difficult, they may choose one question from here. Anyhow, you studied. 5 marks also not a small amount. Now, what are the current period adjustments? The current period consolidation adjustments relate to elimination of intra-group transactions. Now you tell me, students, are you supposed to study this? No, you can bring again your FR knowledge. What is that? Like intra-group interest paid and received, unrealized profits on the assets acquired or transferred, like your inventory, unrealized profit on the inventory asset. These problems are there in FR. The telecommunication company sold one asset, 10 lakh rupees is the profit, 1 lakh rupees is the profit sitting. Deferred taxes on unrealized intercompany profit. These problems are also there in FR. Intra-group indebtedness because of the purchase and sale. Then harmonizing different accounting policies like FIFO and weighted average. Adjustment to the financial statement for the subsequent events that occur between the balance sheet date and the date of the auditor's report. So anything happening subsequent event, that also should be added, is part of your current period adjustment. And now they explain what all the adjustment events. Again, forget it. Simply they have added here. You can ignore because you know it. In this 10 says that there is an adjusting event and a non-adjusting event. So this will occur. Events occurring after the balance sheet which did not require adjustment normally require disclosure. These are all non-adjusting events if they are material. So what you should disclose? The nature of the event and estimate of the financial effect. If it is non-adjusting event, this is the disclosure which you need to make. Now, adjustment for the significant transactions, you can mark it important, that occur between the date of the component's balance sheet and not already recognized in the financial statement and the date of the auditor's report on the group CFS when the financial statement of the component to be used for consolidation are not the date of the balance sheet. Okay, see what they are trying to tell here. Now, these are all adjustments. See, this is your general adjustments, okay, for subsequent events. From when we'll go back again. Adjustment of the financial statements for subsequent events that occur between the balance sheet date, that is 31st March, and the date of auditor's report on the CFS. Okay, which balance sheet? CFS balance sheet. And the date of the CFS auditor's report. So this is a normal. This is normal. SA 560 is going to become applicable. And which balance sheet they are speaking? CFS balance sheet they are speaking. Okay, there can be two types of events, adjusting events and non-adjusting events. But which is this adjusting events they are talking here? Which is this adjustment they are talking? So adjustments for the effects of some transactions that occur between date of components balance sheet. Now, date of components balance sheet can be two. It can be 31st March or it can be 31st December of last year. Not already recognized in its financial statements. Okay, that means this event happened probably, or this confirmation they came to know after their financial state SFS is completed. So once the SFS is completed, they need not do anything. Or if any event occurs, after 31st, like their SFS is completed, then the auditors also have got no responsibility. But when you talk about the date of auditor's report on the group CFS, because consolidation happens only at the end. Now, certain things must have happened. See, this 31st March report could have signed on, say, 30th April. Now, and group report must have done on 30th July. So, between 30th April to 30th July, if something has happened, when the financial statements of component used for consolidation are not drawn up to the same balance sheet as of that of the parent. Okay, so primarily they are talking about 1 minute. They are talking about this particular elements. Okay, they are not talking about this. You remember sometime back I told about the other information. Other information, when the some adjustments happen for the significant events. If the USA subsidiary is drawing balance on the 31st of December, okay, and they are not drawn up to the same balance sheet date, because if you are drawing up to the same balance sheet date, you are covered by the subsequent events. Okay, let us see that example. I have explained it here. The parent XYZ prepares the balance sheet on 31st March, but subsidiary is going to prepare the balance sheet on 31st December. Now CFS is dated when 31st March 2024. Now you are going to verify, your report may be on 30th July. Okay, you will verify all the subsequent events happening for the parent up to 30th July. And if it is requiring disclosures, you will give the disclosures. Now, some February 15, 2024, ABC Limited sells one significant piece of machinery, resulting in major gain. Now, where the US entity? Now, is it part of their financials? No, because their financials are drawn up to 31st December. Now, when the sale happened, 15th of February, is it part of their financials now, SFS? No. Should they revise it? No, because this is when something happened subsequent. This is one significant transaction happened after their balance sheet date. So, something which happens after their balance sheet date, why they need to change their balance sheet on 31st December? Now, are they supposed to give the disclosures? No, because this is something happened later. This is not a this is not your subsequent event only, but it is one of the very significant transaction, okay, where they made a gain. This is not reflected in the ABC's financial statement. That's why it becomes other financial information as of December 23, because it happened after that date. Now, auditor should consider that as a disclosure in CFS. I hope it's clear, students. These parts are clear. You have doubt, please tell me. I can explain it again. So this is what you could read this example, because yes, these are all a bit confusing. So with this example, it should be much clear. So what they are trying to tell, you need to look for adjustments for the significant transactions that occur between the date of the component's balance sheet and the date of auditor's report on group CFS, maybe 30th July, when the component of the financial statements of the component are not drawn up to the balance sheet date of the parent. So this happens only for the foreign subsidiaries, because in India, everybody is going to close on 31st March only. So in case of a foreign component, okay, you need to look for components, convert the components audited financial statement from local GAAP to the GAAP of the parent. This is also your current year adjustment. That means the components financial statement must have drawn as per US GAAP. Now you need to convert into Ind AS. Okay, how that is going to happen, I will show you. I will tell you later. In the reporting part, we will talk about it in detail. So there can be two types of conversion can happen. One, they can completely prepare one Ind AS balance sheet, which is ready-made, consolidated with our CFS. Otherwise, there can be another document called a GAAP adjustments. So in that case, how it looks like, there will be one balance sheet, which is as per US GAAP, which they have filed with their security agencies or whatever, their company's registrar. They will prepare one more document called a GAAP adjustment, where they will tell you the difference, what is the treatment different for USA versus different for Ind AS. Now, these documents together becomes your Ind AS balance sheet. Alternatively, they can prepare only one balance sheet as per Ind AS. So these are the two approaches for GAAP conversions. So this is what you need to check, because this is also part of your current period adjustment. Now, determination of the movement in equity attributable to the minority interest, controlling interest. Like, what is this movement in equity attributable to NCI? That means during this year, you have made a profit, you are given to their share of profit. During this year, you are given dividend, you have to deduct the dividend, their share of dividend. There is a fair value appreciation. Okay, you have to deduct the fair value depreciation increase. So these are all your movement in the equity, and adjustments for the deferred tax for all the temporary differences arising of the elimination of the profit and loss for intergroup transactions. This type of problems also you have done in FR, where you do the stock transfer, stock remains unsold. Okay, deferred tax impact you are going to calculate on that. So is it very easy, students? So this is what we need to talk about. So in this, no, the tricky part was this. So I hope I've explained you with the example and you must have understood what we are trying to talk about. So they may not ask you this. You can write any 4 or 5 points, what all your intra-group adjustments, sorry, what all your current period adjustments. Let us see your test your knowledge 3 questions. Okay, so there is one more here. Write a short notes on permanent adjustments. Okay, very easy. Permanent adjustments can take goodwill or NCI. And your additional consideration is your pre-acquisition reserve, allocation of the pre-acquisition reserve, and additional subsequent acquisition of the shares and changes in their equity. And have you shown on the gross basis or net basis whether the gross is properly disclosed? Easy. Now, while doing the audit of CFS, which current period consolidation adjustment should be taken into account? So they have given up to point number J. So you can write any of those points. Now RTP, they asked you this question. Maybe this type of question can come in the examination. A holds 51% voting power and controls the composition. You are appointed to audit the CFS. So from this you understood it is chapter 13. Now for the financial year, while conducting its audit, you observe that the intra-group transactions have not been eliminated. So now we are talking about something called special consideration for current period adjustments. That is, we are in the planning and performing audit. Concept number 2. We are not even talking about the basics. We are not talking about reporting. So in concept number 2, we are talking about the special consideration for current period and permanent adjustment. Now you are required to guide the management by explaining what is current period adjustment and list the same. So first you explain current period adjustments are those that are made in the accounting period for which the financial statements are done. 1 mark. Now you need to list certain current period adjustments. Like current period adjustment includes elimination of intra-group adjustments, unrealized profits, deferred taxes, indebtedness, okay, your adjustment for significant transactions, gap conversions, impairment loss, deferred tax, okay, impairment loss on the goodwill. For this you need to say partial goodwill method or full goodwill method. So they didn't tell the answer, but they said refer para number 6.2. Yes, that's it. So is it easy? So we had permanent adjustments and considerations for permanent adjustment. So permanent adjustments are only 2. Now then we spoke about the temporary current period adjustments. And now we have to talk about the considerations for current period adjustment. See, primarily everywhere, no? First we will discuss what it is. Then we speak from the audit point of view, how you do audit. You see, everywhere from the beginning, first chapter onward, this is how it works. First you need to understand what and then how. If you pick any questions, there are 3 elements. First, they tell you story or introductory para, from which you may not understand or you may get some hint that it is listed entity. That's it. Second thing, they talk about the issue. It can be one issue or multiple issue. Third, they will ask you a question. It can be one question or multiple question using verbs and the keywords. That the keywords can be sitting in the issue only. So, if you have understood this structure, see, you can answer any of the thing. If you have remembered the structure in which the study material is designed, now tell me, students, and one more thing I will tell you at this point of time, because morning new thoughts comes to my mind. Okay, so before I proceed, see, I'm reading one book and somewhere I'm getting, I know that, but my conviction building that awareness is the starting point for everything, students, and it is pure luck. Awareness. What is awareness? That is being aware. Now, aware about what? Aware about anything in this world. Aware about your mistakes. Aware about how to study. Aware about how to crack. Aware about how to use. Anything. Now, who brings that awareness? Okay. We tell that person as a guru. It can be anything. It can be a bird also. It need not be a person. It can be a situation also. It can be a dead thing also. The moment you start observing something in the nature, if you start getting inputs from the nature, that input could have been given by a human being, a non-human being, a situation, a movie, cereal, anything. Okay, because each of these elements brings that awareness to us. We call them guru, that whoever brings that awareness. Now, once you are aware, please understand, students, that's the starting point. But that won't give you skills. Very important. See, what exercise we are doing here, I'm trying to bring that awareness about this subject. Okay, I'm trying to tell, look, this is the group, this is the meaning of this terminology, this is how they can ask you in the examination, this can be pattern of the question solving, this is what you may have to identify, this may be the meaning of the verb. If they say list, you have to list it. This is the examination pattern. This is how the mark allocation can happen. What is that we are talking here? All time we are talking about awareness. I'm making you aware. This awareness you can get from different sources. Okay. It is like, do you know how to ride a car? You don't know how to ride a car? Okay, I will tell that there is something called a steering. Very simple. Huh? So simple. Step number 1, you have to always switch on the car by keeping some gear in the neutral. Step number 2, you have to press the clutch button, put it in always in the first gear, not in the 5th gear. Small step. Step number 2, after you gather some momentum, press the clutch, put it the gear into the 2nd gear. Like this, as you get a momentum, take it to the 5th gear. Suppose you have got some obstructions, apply the brake, but the movement speed is reduced. Okay, when you are in the 5th gear, press the clutch button and shift it to the 4th gear, then 3rd, then 2nd, then 1st, or then you put it to neutral and put the brake and stop. So I can say this is step number 1. Don't you find that you have learned, you know now? So what you got? You got an awareness. You got an awareness about how to drive a car. Now tell me, without having this awareness, will you be able to proceed further? No. Why? Because if you don't have awareness, you may end up doing mistakes. And what is an awareness? What is expected? Like how to operate something, how this will get done. That itself is an awareness. Okay, since you became perfectly aware now how to ride a car, now I will take you to the driver's seat and say start. You know, theoretically you know step 1, step 2, step 3. Now what is missing, students? Now comes very important thing called motor skills. Remember this word, motor skills. You need to have a motor skills where there should be a coordination between your awareness plus your body. And which part of the body? Particularly hands. So hands has got certain nerves. Your awareness will sit in some portion of your brain. Now there should be one nerve connection between that part of the awareness and your hands. Are you clear? So when you are driving, see, your hands automatically tuned for driving because it gets connected with the awareness what you have about the driving and the skills, motor skills what is required. Now you see, automatically you take the hands to the clutch, gear, brake. The same two hands when it sits in front of one tabla to play. See, I'll give you tabla, play. You can't play. Why? Because you are not aware. And once you become aware, see, your part of the brain gets updated with that awareness. Okay, I can tell you the steps. Na, tari, kita, kita, taka, tira, kita. Did you learn? No. But when you start playing, once you practice, when that motor skills, connect your hand nerves to them. So, there are so many connections. Please understand. That's why I'm telling you repeatedly I'm telling you. These two things, what you have, no? Hands. Fantastic things. That's called motor skills. Always use it. No, I was not aware. If I was aware, no, but I'm following. I told you, no, last meeting, when training course I was sitting. And this is not now. When I was preparing also, always pen was there in my hand. I was not reading it again, leave it. But scribbling is a continuous process. It should happen. Because what exactly it does, it will connect your nerves of the hand to the portion of your brain which has got that awareness. So now that synchronization is going to happen. The more and more you connect, the stronger and stronger the connection is going to become. And what happens on the day of the performance, you can not only talk theory, but you can actually demonstrate in the practical way. Otherwise, you will have something called the illusion of awareness. Illusion of awareness is, you know, by looking at the question paper, you say, sir, I know this. But if I tell you take the pen, you don't know how to write. So this is a very clear-cut sign that you are aware, but you don't have that motor skill. This is called a motor skills. Okay, motor, hands, motor. So I hope you are clear. So let us divide your work into two portions. One, getting an awareness about something. Let's see what we are doing. We are doing awareness. But this awareness is not going to help you only because, okay, you are, when it can help you, if it's an interview question, it's going to help, definitely. Then you don't need motor skills. Why? Because you are asked. So you sit and talk now. You say, sir, consolidation has got 3 concepts. This concept number 1, fantastic. Huh? But if I moment I say take pen and do it, go and do in the IT system. See, IT is different. The moment the same thing you have to do in IT, your hand should be laid on a, where is this picture? The moment I say same skill, but a computer, your hand should be on the keyboard. Because the keyboard should get connected to your portion of your awareness. Otherwise, you know how to, like, for example, your boss, they know how to do this problem using pen and book, pen and paper. Tell them sit in front of the computer and do, they cannot do it. Why? Because that skill they have not learned. So please give priority for the motor skill in your life, students. Don't underestimate it. So the way you get that awareness, because getting awareness is very easy. It doesn't take any effort from you. Does it take any effort? Tell me. Just sit and listen. You became aware. Finish. But don't be under that impression that, oh, you became aware means, okay, you are done. Learning comes by practicing. You take anything, cooking. You saw video, you became aware. But can you do the way they have shown in the video? Okay, I hope you're getting good ideas. No, I'm getting good ideas. Huh? So I'm translating that ideas to you. I'm telling that idea because I'm reading certain books and all. So I'm taking out your efforts out of it. See, my job is to just bring that awareness to you. Even I want awareness in my life also. Okay. The problem is someone else can bring awareness very easily. But we figuring out one thing, it is very difficult. Again, whatever luck factor is required for getting that awareness in life. So now, once you have understood what is a current period adjustment, which is point number A to J, now what is your considerations? See, they could have given this path, but they didn't give. So we will make that path. So you write audit consideration. The auditor should review memorandum of records. Memorandum means draft, temporary records, to verify the adjustment. Because see, these adjustment entries will not be sitting in SFS. This is not part of the SMS. So then where these adjustment entries will sit? Because of everything. See, ultimately your FR is nothing but a journal entry. Your consolidation 110 is all about your journal entries. Without journal entry, your accounts do not speak anything. That means if you are preparing from SFS to CFS, there must be certain journal entries, no, for everything. Now, where you are passing those, that's called memorandum record, Hyperion software. Because for memorandum records also there will be a trial balance that should tally. Because if the SFS is tallying, your adjustment entries are tallying, memorandum entries are tallying, then CFS should tally, right? There is a question that CFS is not tallying. Now, apart from, okay, first thing is you have to verify those memorandum records where these adjustment entries are done. Apart from that, okay, you need to consider certain things more, that verify that intergroup balances are eliminated. So one of the adjustment is eliminating intergroup balances. You please see whether it is eliminated. The audit part is very easy. You just convert what into how you audit. Second, you can tell that intergroup, your interest is income and expenses are eliminated. Verify the CSR has been following uniform accounting policy. Is it not there here? See, harmonization. Same point you can repeat there. Pay special consideration. Verify that the adequate disclosures are made as per AS 21, where in case of application of different accounting policies are impracticable to harmonize. Okay, so there is one difference here. They can ask you very specific examination questions on this point. Note down what they are trying to tell. First of all, you may have multiple subsidiaries, their accounting policies can be different. But when you talk about a CFS, every subsidiary's accounting policy should be as per your parent. This is called a harmonization of accounting policy. FR, you have solved these problems. Now, what if the harmonization is impracticable or it is immaterial or whatever? Then accounting standards comes with the one exemption. They say that, look, Baba, if it is really impracticable to do it because of your nature of the inventory or because of the location or whatever it is, then do one thing, you give disclosure in the notes to account. That means in this case, what happens when you prepare CFS as per accounting standard, there can be two stock. One is parent is doing FIFO and subsidiary is doing weighted average. Why you have not converted into parents? It is not because of the circumstances. It is because it is impracticable to do it. In such cases, let them do according to their policies only, but give disclosure in the notes to accounts. Okay, now let us see whether such exemption is available in Ind AS. But while auditing the CFS under Ind AS, auditor should ensure that appropriate adjustments are made to the group's financial statement and they have to conform to the group accounting policies. No question of impracticability and all there. Okay, now let us see, they have given some examples here. They say that something in the notes, they said point number 1 and some notes they had given. They say that AS 21, line by line consolidation, AS 23, your associate, AS 27, joint venture, permits the application of different policies if it is impracticable to use this uniform policies, and the fact should be disclosed. Now what happened now? This is more like an excuse given now. Then everywhere, every time they say that this is impracticable, it is time consuming, it is costly. Okay, together with the proportionate item, how? Just see, simple, no, just give one disclosure. Like if I say, if it is impracticable to read it, then okay, if it's impracticable to write the exam, just read and go. Then what happens? No, you may say, sir, no, it's always impracticable. Why? Because reading is easy, no. Giving disclosure is easy. So management may always follow that practice of just giving disclosures, not to consolidate, by giving an excuse of impracticability. But Ind AS 28 permits the financial statement of an associate can be prepared using different accounting policies if it is impracticable. Okay. However, adjustment shall be made to the accounting policies to conform to that of parent when the parent's statements are used by the parent in applying equity method. Okay, so what they are trying to tell, if the associates are okay, because it can be really impractical, because we cannot tell our associate to follow our accounting policy. See, this is what they are trying to tell. So let the associate follow a different policy only, but we don't give that exemptions of disclosure to you if you are following equity method. That means your adjustment should happen as per the parent's policy. So in short, friends, whatever this example they are given, you ignore it. You understand one thing. Accounting standard permits for different accounting policies with the disclosure. Ind AS do not provide any such exemption. Okay, this is one thing you need to keep in mind, consider. Then verify the adjustment to be made to harmonize different accounting policies and to convert the components into gap of the parent. Okay, so that's nothing but gap conversion. Again, this is the same point of this. Very easy. Then verify the calculation of the minority and non-controlling interest. What you have done? Have you not done this? Movement in the equity. Verify its calculation. Verify the adjustment related to the deferred tax for the temporary difference and elimination of the profit. What is this point? Same thing, that they have to eliminate and you have to verify. So add the word verify everywhere. So with this, you are done. Verify the income and expenses of the subsidiary are included in the CFS from the date it gains control. That means subsequent. So pre-acquisition reserves gone to P&L. Post-acquisition reserves are going to your other equity, and it will ceases from the date the control is stopped based on the amounts and the recognized in the consolidated statement at the acquisition date. Okay, so any 4 or 5 points you can talk about it. So I hope it's very clear, friends. Very easy also to remember. So what are your current period adjustments? They have given you the list of current period adjustments. Now, what is your special consideration? Okay, you see that you are going to verify whether all those adjustments are done. But one of the very important adjustment they have not spoken there is about the impairment of the goodwill. So in the suggested answer, see, point number 11 they brought, which was not there in point number A to J. Okay, now let us see what is that impairment about the goodwill you need to see. So one of the important adjustment in determination of the impairment loss, because your Ind AS 38 says that 3 items has to be, see, impairment has to be evaluated only when there are indicators of impairment. Okay, only if you see indicators of impairment, then only you have to calculate the impairment loss. But 3 items, you have to always calculate the impairment every year. What is that? 1, work in progress, some intangibles not yet ready for use. Second, intangibles having perpetual life. Third, goodwill. That means goodwill should be tested for impairment every year. So this is the point you are going to tell. So you bring your Ind AS 38 knowledge. Tell that Ind AS 38 it says this. Now, one of the Ind AS 36 impairment. Now, one of the important adjustments that may be required in the current period determination of impairment loss that may exist for goodwill arising on consolidation. Okay. Point number 1. Goodwill should be tested for impairment at every balance sheet date. Who told? Ind AS 36 told. Second, verify the procedure followed for determination of the impairment loss. Like how did you calculate the impairment loss? Partial goodwill method, full goodwill method. Okay, you have got this, what is it called? That component which is added, no? Cash generating unit, CGU. How did you calculate the CGU? Okay, what are the CGUs? Yeah, all these things you have done in Ind AS 36, and consolidation related adjustments also happened there. So that's what you're going to verify. Third, impairment loss in goodwill. In case the impairment loss is determined based on the foreign currency. Okay, this problem is also there in your FR. If the impairment loss in goodwill happens in foreign currency, the amount should be transferred in local currency. Obviously, translation has to happen, and the difference should be adjusted to the translation reserve. Point number 3. This is your special consideration. Fourth, the auditor should also perform procedures to understand and verify whether intra-group losses are indicating impairment loss. Okay, what is this intra-group loss? See, if you have got any intra-group profits, you will eliminate it. Agree with me? Like for example, the best example, if I give you in FR, the telecommunication is selling one building from parent to subsidiary, 1 lakh rupees is the profit, whatever. Now, if you have sold any asset at a loss, now, are you supposed to eliminate that loss? You will eliminate by passing journal entry. But you see, if you are selling any asset at a loss, is it not an indicator of the impairment loss for that particular asset? Like normally, intra-group profit and losses are eliminated. However, both profit is also eliminated, loss is also eliminated, because this is automatic. It is not that you passed one separate entry for it. The moment you eliminate the intra-group transaction, your loss also got eliminated. But intra-group loss indicates that asset must have lost its value. That's why you should not eliminate that loss. Instead, you have to recognize that impairment loss. You have to recognize the impairment loss. This is what they are telling in point number 4. This is also a special consideration. Now, apart from verifying, please check whether the minority share of the loss has exceeded. Okay, I think, yeah, I should have given one different heading here, friends. Yeah, because this is impairment of the goodwill is only having 4 points. Okay, now I need to give separate heading called NCI adjustments. Okay, what can happen with the NCI? NCI, because of the losses allotted to the NCI may show a negative balance. Now, when the NCI shows a negative balance, there are two types of treatment. As per accounting standard, you should not show NCI with negative balance. So, who should bear this? This problem is also there in FR. If the NCI is having a negative balance, you should stop charging negative loss to the NCI if you are following accounting standard, and that loss should be borne by the parent. And the day when the profit is accrued, this losses which is separately accounted by the parent, which is borne by the parent, has to be made good. And after it is consumed, then you can start allocating profit to the NCI. But your Ind AS says, no, Baba, this type of adjustments you don't do. Even though NCI has got a negative balance, you show that negative balance in the financials. Don't charge that loss to the parent. So that's why if the minority interest share of loss, that's why they use the word minority interest. Why? Because accounting standards we are talking. If the minority interest share of loss exceeds the share of the equity, the excess of any further loss will be accounted as per accounting standard. That means no negative balance for minority interest. However, if it is an Ind AS, then negative balance can be shown. Then one more special consideration, okay, is your financial statement date of the components. Now, what is that financial statement date? Okay, previously we have seen some examples. Now, what is the special consideration I need to have as part of the current year adjustment? Now, financial statement of the component should be of the same reporting date as that of parent. Both should be of 31st March. However, it may not be practicable to draw up the financial statement of one or more components on such date. Accordingly, the financial statements are drawn up to different dates. That means somebody could be on 31st December. In such cases, adjustment should be made for significant transactions and events that occur between the date of the parent and this is also your current period adjustments. This also becomes your current period adjustment. Okay, where we have come across this particular element, if we go back, I gave an examples to, I showed you, okay, adjustments of the current period. So this is nothing but point number G. The same thing they are discussing now. I could have put this as that auditor has to verify point number EFG here. I could have put this point GH. Followed, no? But they have discussed this point a bit later. They have given more light on this. They said what your Companies Act says that it should be drawn at the same date. However, it is impracticable, then the adjustment should be made for the significant transaction. However, whatever the difference, it should not be more than 6 months under accounting standard, 3 months under Ind AS. That means if you are following Ind AS, max to max your financial statement date should be 31st December. But if your accounting standard, their closing can be 31st October also. Anyhow, we will talk about, because practically either across the world, either it is 31st December or 31st March. And what is the reason? Did we discuss this reason? Do you know why US follows 31st December and we follow 31st March? Are you aware about this reason? Okay, the reason goes like this. Primarily, we have got two groups of countries out of 182 countries or 190 countries. We can primarily classify them into two groups called the developed and the developing. Now, developed countries generally follow 31st December as their closing. Like France you take, Germany you take, okay, USA you take, UK you take. But we follow 31st March. Okay, what is the reason here? Why we took 3 months? See, by 31st March, the financial statements of those US companies gets finalized. So from 1st of January, audit starts. Somewhere in the month of Feb, okay, or March, because 2 to 3 months the audit will take place, 1 to 2 months or whatever. So by 31st March, I can say, I'll put one cutoff. By 31st March, your AGM would have completed for this US based companies. Dividend would have got declared. And that dividend, by the month of April, you have got dividend in your hand. Okay. Or you might have seen the company didn't disclose the dividend. That means you must have become angry about that company, angry about your investment. So you will be into two scenario. Either you are happy with this company or you are not happy with the company. If you are not happy with the company, you have got dividend. If you are not happy with the company, you are planning to sell it. Now, if you want to sell it, then where you invest now this money? If you got dividend, where you are going to plan to invest this dividend? Now, you are in the thinking phase. At that time, we close the financials now, 31st March. By April or May, our audits get over. And by that, audited financial statements come out now. Okay. Now, these investors can think, okay, is this a good opportunity to invest in India? Because this Reliance Industries is showing good profits. So, Warren Buffett may think to divert his investment from USA to India. That's the reason, students, we have kept 31st March. Otherwise, no, 31st, see, our New Year resolution and all, we will always consider calendar year. Correct? Because from 1st January, we always form a new year resolution. But this taxation, yes, it should suit to our accounting now, closure. That's why our tax years are like this on so and so date. So our primary objective of closing is to attract the investments, and we are talking of 1950s, not now. Today, we may say, okay, still we want money, but in 1950s and all, we barely wanted money. We wanted foreign investments to happen in India. Now, that's the reason we may have two reporting dates here. The auditor should look for the significant transaction, and the recognition should be given by a disclosure, or otherwise effect of intervening effect which may materially affect the financial position of the transaction. I mean, if you figure out such a significant transaction, how should you recognize it? You have to give that disclosure in the CFS. Now, the fundamental accounting assumption of consistency has to be followed, that consider whether the length of the reporting period and difference in the financial year are same from period to period. That means last year they followed 31st December. Now they have shifted to 31st, this year they have gone to 31st Jan. Okay. And next year they are again on 31st March. See, this type of change in the reporting period, okay, change in the length of the period, because what is our length? Is it 12 months? Need not be. We can take 16 months. Some subsidiary can 18 months, 12 months, 8 months, 16 months. See, like this different periods, this is going to create a confusion. So if someone is taking 12 months, let them take 12 months length of the reporting period. If someone 31st March, 31st December, let it be 31st December only. So it should be consistent from year on year. If there is any changes, then such matters has to be disclosed. So in this para, they have expanded on point number G, which I have given this example. The auditor has to verify it. That's it. How you need to verify? Whether it is given, disclosed in the financial statement, and consistency has been followed. It is also easy, students. So we can make this also one of the points to verify. Yes. Now comes the disclosures. Okay, so we will hold up to here because I want to talk to you more on the disclosures, why separate disclosures are not required. With this, we will be done with this particular para also. Okay, so we will do the disclosures in the evening. Okay, probably by today evening we will finish this chapter. Yeah, I hope you are clear. Chapter is simple, right? Easy, no? Practice, huh? So you became aware about how this is organized. Now comes the practice. So you make a map, you write it, you write and practice the para. Thank you.